Welcome to Financially Fluent with Ray Godleski of Southeast Wealth Partners. Our goal is to equip you with the knowledge and tools necessary to navigate your financial journey with greater ease and efficiency.
Good morning, listeners. Hopefully you enjoyed part one of my podcast with CPA Josh Roper well enough to listen to part two. And in this episode, Josh is going to be discussing short-term rental properties, 1031 exchanges, and some critical reporting for contractors. And also how, CPAs and financial planners can collaborate with each other. So I hope you enjoy. Now, you mentioned real estate, and I got, clients that are realtors. I just recorded another episode the other day with a top realtor in the area. A lot of people are in real estate investments, right? And so let's just kind of give an overview of kind of the depreciation, passive income rules. I think you and I can both talk about 1031 exchanges, but let's kind of start with the depreciation and passive income rules.
Are we talking about like if I have a residential rental property or a commercial rental property?
Yeah, maybe you got a single family home and you're renting it out and you've been renting it out for years. Yeah.
Okay, so that's very common, right? So we have a lot of clients that, maybe they rented out their first home instead of selling it. So what happens is, if I have a W-2 job and I go to that job 40 hours a week and I have this single property that I'm renting, that means my real job is this W-2 job. I'm not a real estate agent. So any income I earn off of that property is what's referred to as passive, right? It's income that I'm getting. I'm not actively involved in the business and I'm not doing much to get it, right? So that's really passive income. Again, where my W-2 job would be my active income because I am physically participating to get that income in, right? So they're taxed in different ways. So, and it's a major misconception. The income is taxed basically the same, right? It's the losses that are treated differently. The benefit of a single residential property is that you're hoping that it's tax negative with depreciation, but cash positive, right? That's the ultimate goal. But in a situation where it does start kicking off income, or let's say that it's book negative, but cash positive, then we have a loss for that property, right? If my income is below a certain level, I believe it's $140,000, and I can take that loss even though that's passive income. If I'm above $140,000, I'm not allowed to take that loss. That's just the threshold. And then that loss gets deferred until future years, until either I do have income, passive income to offset that loss, or I sell the property. Does that make sense?
It does. And I guess the other thing too, if it's passive income, now that gets tricky too, right? If they're a realtor and they own some rental property, it's not necessary. There's some different treatment around that property. Is that right?
Yeah, you can imagine. I mean, if you're a realtor and you own several, then you're a real estate professional, and then everything becomes active at that point.
Right. But if you're not, and it's strictly passive, if you're trying, and let's say it was doing really well from a taxable standpoint, like it's making taxable income, and they're thinking let me just open up a retirement account against that. That's not allowed, right? You can't do on passive income.
No, you have to have your income, but you could offset your other income. I mean,
right. But if you were like retired or something, you got pension, you got Social Security, you got realtor income. There is no way to really, there's not no way, but there's less ways to kind of offset that. And then the other thing that's trending, if you will, again, I think from the pandemic somewhat, is the short-term rentals, Airbnb income. Are those treated any differently? Or are they pretty much the same?
No, they're actually treated much differently. So they're treated like a small business. So short-term rentals are all active. So active income, active losses, where long-term rentals are more passive.
Okay. So if you hired a person to manage a property, that's just an expense, and it's still, like you said, it's an active business. Yeah. And then you just hope the whatever ordinance that is there doesn't change their ways and doesn't allow Airbnbs anymore, or something like that, right?
Yeah. And that tenants don't destroy the property.
Right. And which one did destroy it, right? You don't know. Okay. And then 1031 exchanges. Let me back up for a sec.
Sure.
Just so that the listeners know, you kind of said this earlier. If you're married, filed jointly, and you sell a property, your primary home, you got to live there at least 2 of the last 5 years. Yep. And it's a beautiful thing. You get up to $500,000 of capital gains tax free. And then if you made $510,000, it's my understanding, not that bad. You're paying capital gains on $10,000. Now, talking about federal, is that fair?
Yes, that's accurate. Correct.
Great, great. But now a 1031 exchange is going to come into play on a investment property. So kind of walk us through, that if you want to.
It used to be for business use assets, right? So, and that included both real property and personal property. Real property is real estate. Personal property is everything that's not real property, right? So, in 2017, with the TCJA, they took away the 1031 for personal property, right? Like a vehicle, that's personal property. I would go trade, and now it's only applicable to real property. So, if I have like the residential house that I'm renting out, and let's say that it's appreciated very well, and I'm ready maybe to get into something bigger, and I don't want to necessarily sell the property, then I can do what's called a 1031 exchange. And the great thing about 1031 exchanges is it used to be, an asset for asset exchange, but they've expanded it. And now you have a bunch of different options. You can go into an escrow exchange fund, kind of like an investment, almost like a mutual fund for 1031s. So you can do a bunch of different things. But in theory, what you do is you say, okay, I'm going to go and take this property with a large amount of appreciation. I'm going to first engage an attorney and an intermediary, and then I'm going to go through the process of exchanging the property. And so basically, you sell your property, roll the proceeds into the new property, and that gain is deferred until you sell the new property. There's some caveats, right? So you want to make sure that you're always going up. If I've got $1 million property, I don't want to do a 1031 for a $500,000 property. I want to go to $1 million or $1.5 million. And then that helps that gain deferral. Does that make sense?
Yeah, it does. I think one of the things for folks to definitely keep in mind is that when prior to the sale or at the sale, they got that qualified intermediary already in place.
Yes.
So that it's not going into, to
First thing you want to do, once you decide you want to do a 1031, you may be browsing properties, but the second thing you want to do is go get that intermediary and attorney lined up.
And then let's say someone does it, so they're not paying the tax yet, they're deferring it, kicking it to later. And from an estate planning perspective, if they kept 1031 in properties and eventually they pass on, and it could go to their kids, and with current tax law, they would get a step up in basis. Is that pretty true?
Yeah, it's 754, and that's on the chopping block, or at least it has been. So assuming that sticks around, yeah.
I don't think with the current administration they're going to do anything with real estate tax law, but you were correct. Previously, it was on the chopping block. And I think the other thing I am kind of curious about, let's say someone 1031s and they rent out the property, and then eventually they sell their primary home, and they collect their profits from it, and then they want to move into the property they've been renting out for the last 5 years. And could they then make that be their primary home?
I believe so. I'm not specific on the details, but I believe there's a 5-year holding period once you complete the exchange. And then it modifies whatever the gain is after that. I don't know the specifics off the top of my head.
Okay. No, that's cool.
Yeah.
All right. The other thing is people hear the word CPA, tax preparer, financial planner. Let's kind of and I know it's different depending on the CPA. It's different depending on, for example, some CPAs may mostly be in the tax return business, just like financial advisors. They may just like manage an account, right? But where do you kind of see those lines, and kind of give some examples of where you've seen some collaboration be helpful, and maybe even when should somebody even hire a CPA? I mean, I feel like if, they're a W-2 employee, do they need a CPA?
No, unfortunately, our tax law is overly complex, right? And so it does put a burden on the taxpayer to comply. So, you have a tax preparer who may or may not have a credential. You have one that could be an EA, which is an enrolled agent, which is credentialed through the IRS directly, and then a CPA, right? So those are basically your three choices. I would probably never go with one that's not credentialed unless they could just show an extreme amount of experience. But then an EA is pretty good, right? I wouldn't go to the big box shops, right? So if you're a small business owner, I think, you've got a simple business return, and you've got a simple individual return. There's a lot of great EAs that are highly qualified that'll do it at a very good price. If you have a growing business, and, it's multi-state, multi-product line, and then you need other support from a tax planning, and then maybe some financial and a test reporting support, then I would probably go with a CPA. So if I have a lot of small businesses that, I don't think that I can help, then I either refer them out or send them to my partner who does much smaller returns. But if it's a growing business and they want advice on how to grow that business and, what the steps are to grow the business, hire the right people, get a line of credit in place, and all of the fundamentals that go with, building a good business, then, CPAs are good for that sometimes. But,
Right.
they all may have their specialty, right? I specialize in construction. I couldn't give anybody any advice on healthcare or banking, right? But, but I could on
Yeah.
construction. But
Yeah.
then you have financial planners who you brought up as well. And a lot of financial planning firms will also prepare tax returns.
Mm.
And there's nothing wrong with that. Generally they hire someone in-house or, outsource it. But, I kind of like to let people stay in their lane, right? Like a free tax return doesn't mean anything to me if you're my investment advisor. You know what I mean? I want you to focus on my investments and my strategy and our long-term plan. And I can get the tax return taken care of somewhere else. But I'm a big believer in staying in their lane. You do financial planning, you focus on financial planning. I
Right.
focus on business taxes. I'll focus on business taxes. You know what I mean?
Mm-hmm.
And then when it comes to do the individual taxes, I hope that we can work together to do what's in the best interest of the client, And so for my larger clients who do have portfolios, reaching out to the financial planners is part of the tax planning process, because they could have huge gains or losses, et cetera, that could affect other situations in their tax plan or even their overall income. And so we work together with them to understand that knowledge.
And now, a quick message from today's sponsor. If you're looking for advice specific to your situation, then take a look at this episode's sponsor, Southeast Wealth Partners. To learn more about their team and approach, go to southeastwealthpartners.com. Southeast Wealth Partners is a great next step to be financially fluent.
What I like to do is kind of do some projections on what's going to happen in the future, but I love it when people have a CPA that's responsive, because oftentimes the tactical answer for that year really, I feel better when there's a CPA involved versus, they did it themselves on the back of a napkin or Quicken or whatever. I would much rather have a CPA say, no, you forgot about this, this, and this, So I'm a big fan of collaboration.
Well, we try to do it differently. I like to think so. A lot of the tax preparation and for tax preparers, the tax process starts in January. Our tax process for small business owners starts in August.
Mm-hmm.
And when we look and we say, okay, what has happened for the past 8 months? What transactions have transpired that would affect your tax situation? Then we try to look to the future. And then we put together a picture and then run that forecast of the business down to the individual owner's income tax projection. And then we can say in October, okay, this is what your tax liability is going to be in April. What decisions do we want to make in October to minimize that liability? Do we want to make a profit sharing contribution, HSA contribution? Do we want to go buy more equipment, bonus out our employees more, right? So we make all those soft planning decisions in the third and fourth quarter. So the first quarter really does become, compliance. And what I think the value on that is it allows us time to reach out to other service providers like their financial planners and, see what the activity is or what, the intentions are for the rest of the year. If they bought a commercial building, we can go ahead and engage a third-party specialist to start doing the cost segregation study before the end of the year instead of after the end of the year. You see what I'm saying? So we really try to drive that process in the third and the fourth quarter so we can get that collaborative effort in for the client to get them their best results.
And I know you specialize, and you mentioned it, with a lot of commercial contractors. So I know that's something you do real well in. For those, and I know some people like that, what are some of again, we're not talking about just a tax return, some of the report functions that you do that these folks really need to know about, and whether they have someone or don't have someone, they probably need to make sure whoever they're using is running some of these critical reports so that they're excelling in their business for those commercial contractors that are out there?
Yeah, what a lot of people don't understand, and this is an epiphany for a lot of small business owners, is you run two sets of books. Okay. And I know that, well, wait a minute, that sounds
Hmm.
shady. Well, it's not, because there's two sets of rules, right? So
Hmm.
we have our GAAP or our financial rules, and then we have our tax rules, and we're allowed to have separate books based off of the rules. So what we do with the small business owners is we maximize their financial statement presentation. We make the balance sheet and the income statement look as strong as possible. And for construction companies, for example, that helps them with licensing issues, that helps them with bonding issues, and it helps them with lending issues. And then on the flip side of that, we say, okay, now that we got the balance sheet and the financial statements looking great, now let's see how poor we can make it to the IRS. And then we kind of just do the flip and say, we cry poverty, to the IRS, and, try to
Right.
minimize that taxes. So it's really, a lot of people will say, how do I run the books of my business, right? You run the books on your business on how you want to manage the business, on how you'll know what you're owed and what you owe and what you'll collect and all your cash forecasts, right? Your profitability. And then it's a whole different situation on the tax side. So what I try to tell people is manage your business on with your books, how you need to do it to maximize your profits, and then we'll flip it and plan it on the tax side. Does that make sense? So depreciation is a great example. If I'm a construction contractor and I've got equipment, I want to depreciate that truck over 6 years or 7 years because it's a lower hit to my income statement. It makes my equity look bigger, right? But on the tax side, we want to write it all off in the same year so we get those tax savings and reinvest that money back in the company. So I just say we run two sets of books, one to manage the business, one to the report to the IRS. Make sense?
It does. It does. So I think we've probably got a little more topic area, and that's going to be new tax code stuff. But before we get into that, let's just kind of remind people about deadlines, meaning what are the key deadlines on their quarterlies and filing and extension.
Sure. So the extended deadline, well, let's see, the next quarterly payment is 6/15. So if you have an estimate, it'll be due then. Then another one at 9/15. We have a business deadline of 9/15 as well. And then a individual deadline of 10/15. So you have plenty of time to get all the taxes in, or get your information in for the taxes. I always say don't wait till the last minute, right? If you've got all your stuff in, get it in now, because then you can move on to planning for the next year. And a lot of people, and I'll take this and give some CPA woe is me, right? If everybody waits till the last minute to give in their tax stuff, then the quality of everything diminishes, right? Because it's all a mad rush to the deadline, right? The sooner you get your stuff into your CPA, the better quality products you're going to get, the better responsiveness you're going to get, and the better relationship you'll have. But if you're always waiting till the last minute, you're really putting your CPA in a situation where there's not much they can do.
Yeah, and I know you saw an article, or you probably know a little bit more than I do. I just kind of looked at an article recently about the proposed tax cut that's coming up. So I know this is not law, it's not legislation. Nobody needs to take any action based upon what you and I are about to say. But what are some of the things you think might change with the new tax cut, and what are some of the things that might stay the same?
Well, like I said, I read an article based off our discussion earlier. I read, an article last night, and everything looks to be an extension of current tax law, right? So there's not going to be some big overhaul that's going to come in. They're going to take the current foundation and they're going to increase the limits and make a few tweaks. Some of the biggest areas that I'm looking forward to for some of my clients is the original TCJA took away in section 174. It disallowed R&D expenditures to be deductible in the year incurred. You had to amortize them over 5 years with a half-year convention. So if I had $1 million in R&D expenditures, I had to amortize them over 5+ years. And so obviously my tax burden went up, even though I got a nominal credit, right? So they've already voted to do away with the amortization of R&D expenditures. And now we're just waiting to see if they're going to be retroactive. So this could be the year of amendments for any businesses with R&D. So I'm looking forward to that because, companies shouldn't be penalized for trying to, advance knowledge. The estate tax will be fixed, right? Everybody was worried about the limit dropping down at the end of 2025. I believe that'll go back and give everyone some comfort. The estate tax attorneys won't get to bill as many hours next year, but that is what it is. But other than that, from what I've read so far, it's going to be more of the same of the TCJA, just with some higher limits.
Yeah, I think I saw where 199A, which I believe has to do with We love acronyms, right? QBI, which is Qualified Business Income. They may move that from 20 to 23%, so that'd be kind of cool.
Oh, that would be very nice. So just so you know, the reason they lowered the reason why we have QBI is because they took the C Corp from 35 to 21%, right? And then so if now the QBI is going to go to 23%, and I think that's because they're talking about lowering the corporate rate even to more, I believe. But once you get up to, I believe it's about $500,000 or $600,000 between a C Corp and an S Corp, there's nominal difference.
Okay. And I don't know if they'll change any of the 162 rules or not. I guess we'll just wait and see.
It's, I like to, it's kind of like, I take these tax season packages like preseason. You put them on in the background and, watch them. You don't really care about the outcome until the game starts, so
Right.
I don't really pay much attention until they issue the final.
Yeah. And one other thing I know you may not have heard on this is they may not tax tips or overtime, which I think would thrill a lot of people. I don't know how that helps the deficit necessarily, but I mean, that would be an interesting, and not taxing Social Security. That would also be, to me, a little surprising, but I know I've heard people talk about it.
I don't think Social Security should be taxed anyway. That's just personal opinion.
That's how it first came out. Yep.
Yeah, when the tax on tips and all that would be great. But I think what they'll do is they'll segment that to industry specific, like they did for QBI. So a lot of people don't know what QBI is, specific for industries, right? And so, for example, accountants and financial planners, get hit hard by QBI, where architects and engineers who do almost the same thing get to benefit from it. You see what I'm saying? So I think that's the way that the no tax on tips will be targeted.
Yeah. All right. Well, this has been really good to spend some time with you. We're getting towards the end, and you're not going to be able to escape without a trivia question. Today, sometimes I give people choices, different topics. I'm so sorry we haven't had sports yet, so you get voluntold for a sports trivia question. But I will let you pick. We have an 80s baseball trivia question or a 90s NBA one.
90s
What's it going to
NBA.
be? 90s NBA. Okay, here we go. Gosh, which NBA team won back-to-back titles in 1994 and 1995?
Houston Rockets.
Nice. Yeah, you didn't go with the Bulls. So how did you know this?
Michael Jordan is probably he's my guy, right?
Yeah.
Saw every game. So those were the 2 years he was out.
That's exactly right. Yeah, I know that's crazy. They did three-peat, take 2 years off, another three-peat. Absolutely amazing. So good. All right. Well, if we're going to do some team trivia locally, I'll get you on my team.
Wait, what was the 80s baseball question? I just want to see if I got that.
Yeah, let's do it. Bonus time. Here we go. This one's tough. Which team won the 1985 World Series, making a dramatic comeback after being down 3-1 in a series?
Dodgers?
No. I'll give you a hint.
Okay.
The one that was up 3-1 and blew it was the St. Louis Cardinals.
Oh my gosh. That's 80s. That's maybe before. I was just a kid. So
Yeah. Well, the team that won had a lefty that was pretty badass baseball player. Always had a real had something in his cheek.
Diamondbacks?
The Kansas City Royals.
Oh, the Royals. Who was the pitcher?
I don't know. Honestly, I don't. I know they had Quisenberry, I think, as like a reliever, maybe.
That's funny.
But yeah, the Cardinals usually win, but they actually blew that one. So
wow, I didn't even know the Royals ever won one.
I didn't. Yeah, pretty cool. So okay, well, Josh, thank you for being here with Altruist CPAs, and for our audience, this concludes this episode of Financially Fluent. If you have questions about retirement or business owner questions, please send them in. Those are good contents for our show. Cindy and I like to do some Q&As as well for these podcasts. Send it to Ray at southeastwealthpartners.com, and feel free to subscribe and share this episode. Thank you so much.
Great. Thank you so much, Ray. Thanks for having me.
Thank you for listening to the Financially Fluent podcast. Click the subscribe button below to be notified when new episodes become available.
This communication is for informational purposes only and should not be considered tax, legal, or accounting advice. You should consult with a qualified tax professional, accountant, or legal advisor regarding your specific situation before making any financial decisions. Investment advisory services are provided only in compliance with applicable laws and regulations. Ray's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. The information on Financially Fluent does not constitute a solicitation of the sale or purchase of securities. You should consult a professional advisor before executing a security trade or taking any other action based on information contained in this program. Securities and investment advisory services offered through Osaic Wealth, Inc., member, FINRA SIPC. Osaic Wealth is separately owned and/or other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.